Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. So once again, we're going through all things FX markets, global markets, give us a sense of where we've been, where we could potentially going, the landmines that we need to expose ourselves, our portfolios to, and the risks around that. And we can make an informed decision, hopefully, whether or not we want to expose our portfolios, our positions to those risks going forward, and ultimately what the market's expecting. But let's go straight into the boards and let's have a look at a deep dive into where we've been to give a sense of and a guide. Things are looking a little bit better. We'll talk about that in the assessment of market sentiment in a moment. But you can see here when we're looking at major currencies, people are taking a little bit more risk on in their portfolios. Things are looking a little bit better. People are looking at the coronavirus with, I suppose, rose-tinted glasses at the moment. I think that's largely down to the PBOC. I think they can have a really strong hand in that. They've flooded the world with liquidity. They've really come in to try and suppress market volatility. I think there's been other central banks around Asia who have number of measures and talked down their currencies. I'm thinking of the MAS, for example, but certainly central banks have come back to the rescue around Asia as well and done what needs to be done. But I think, you know, in coronavirus as well, again, we look at recovery rates and they seem to be picking up a little bit. The containment aspect is something that markets are looking at very closely. But you can see the Korean won doing very nicely. We love looking at the Korean won as a sense of risk-taking in the market. Dollar Korea won or Korea won against the yen. I think it's always an interesting one. We're seeing some buying in the Taiwanese dollar. The MEX is doing well. Oil prices have started to respond. We got down to 49.31 on WTI. Brent prices obviously have had a bit of a reversal. We're watching what's happened as we're coming through the new week. Can OPEC come to the rescue of the oil price? We're not so sure. Rallies are to be sold, in my opinion, in the energy complex. But we are watching the response on the supply side. It's been a demand problem. China's obviously slowing down. They're going to take a hit in Q1. The demand for oil is obviously going to be, been talking about 20-25% falls in there. So the oil price obviously lower, but OPEC are coming back to the rescue. Perhaps Russia's on board. The petro currencies are starting to respond. So CAD against, the pound has been looking like an interesting trade. CAD Swissy looking interesting. CAD Euro interesting as well, with the NOK there as well looking quite good. But yeah, you can see the situation there. On the downside, it's been the Singapore dollar. We've seen really big increased flow in the Singapore dollar. It's not usually a currency pair we see too much interest in from clients, but it's got a bit of a Tesla moment. If you have a look at the daily chart of dollar against the Singapore dollar, you've seen that really strong move up from around 134.50 mid-January up until the high 138, which doesn't sound like a lot, but when you're talking about a pretty low beta currency that's part managed, that's had a sort of a Tesla moment there. The SAF doing pretty poorly, down 88 points as well against what is a pretty strong currency. The dollar looks like it wants to move higher, regardless of everyone saying that it's going to be a weak currency this year. But that's where we are in terms of major currencies. Going to emerging currencies, again, we've got the Korean won, the best performer there on the week. The Indonesian rupiah looking pretty good. We're starting to see the emergence of carry coming back on that. Implied vol is moving lower. Markets are moving higher in terms of risk-taking. Equity, fixed income, in terms of yields, are staying fairly subdued, and that's allowing us to go back into carry. So people want to get paid. They're moving into the rupiah. We've got some buying coming back in the rupiah, and again, some of the LATAM currencies are doing quite well as well. On the downside, it's been the Hungarian forint, the Singapore dollar, and the South African rand, which has been the worst performers this week. Whether that continues, obviously, are yet to be seen. Now, let's go to assess market sentiment. I always want to have a look at the backdrop by which we're going to assess from a sort of broad macro perspective how markets are shaping up. I love this chart. It gives me really good understanding about what people are feeling, the psychology in the market. You've got the yellow line there on the top pane being the S&P 500. We're making new all-time highs. That's a solid situation to be in. The Nasdaq similar. European markets look pretty good. DAX looks quite attractive at the moment. We've seen high yield credit spreads. If you look at the white line at the top pane, we did see high yield credit spreads widening relative to the 10-year, or we call that the risk-free rate effectively. They'd seen that those credit spreads moving up quite sharply. That was obviously a perception that credit was seeing some signs of stress, but it wasn't too bad. But we've seen that rolling back over. Credit spreads are starting to narrow. The red line there being the implied volatility, the S&P, the VIX, that started to roll back down, and of course that's allowed the financial conditions index, the purple line on the bottom pane, to move down to potentially target all-time lows there. Central banks, specifically the Fed, look at financial conditions above everything else, in my opinion. If financial conditions start to move higher, like we saw let's go back to 2018, for example, they will respond. But with financial conditions near all-time lows, there's not really much of a need to move rates on that. So for that gives me a situation that we go in the new week fairly happy with risk. Let's have a look at this chart here. I love looking at Aussie yen. Again, you've got the white line I look at the vol structures. We call this vol spreads. I've got the front end vols or short-term vols, 1 month implied volatility in Aussie yen, and I've looked at that relative to the difference between 1 year, so slightly longer term. As we see from the white line, we've seen that moving higher. It showed that short-term implied volatility had been moving up more aggressively. People were seeing near-term risk. Those price moves were getting elevated price moves were being expected relative to longer-term moves. And what we'd seen there is Aussie yen obviously moving lower. And I can use this in some ways predictive powers for spot. What we're seeing now is that those short-term vols are moving down on a relative basis to long-term vols, and that tells me that Aussie yen has responded in kind to that. So that's something I'm watching as we're going. It hasn't really come out of the woodshed yet. I mean, it's still at fairly elevated levels relative to where we were back in December. And we watch that. We want to see, for people who are long Aussie yen, we really want to see those short-term vols, really 1 week and 1 month vols, moving down much more sharply relative to longer-term implied volatility. I also like to look at this chart as well, and specifically the top one. It's the implied volatility of 25 delta S&P call options relative to the implied volatility of 25 delta 1 month put options. At the moment, puts trade at a premium, put implied volatility trades at a premium of 5.34 vols. That tells me that that's generally what you see. People implied volatility tends to be higher for puts than it does for calls for 1 month S&P. But what we have seen of late is that moving higher. That red line has been mean reverting back to the blue line in the middle, which is the mean. So it has mean reverted somewhat, and that tells me that people have somewhat reduced those tail risk hedges to their portfolio. People have really paid up for that put optionality to really protect against downside on the S&P. What we've seen there is a relative outperformance from call volatility, and that's been moving up more sharply relative to puts. There's still a differential between the two, but that has mean reverted. So we come into the new week, I think, confirming there that we are seeing somewhat better signs. Let's have a look at some charts of interest. The dollar on the top one, the top pane here is testing that multi-month supply zone that we've got around sort of 98.50. We're in this bullish channel. We're just sticking our head across that precipice at the moment. Will that non-farm payrolls number be the one there? I'm not so sure we want to be too sensitive. Let's have a look at the wage growth coming through in there. That'll give us a sign of what's happening. In fact, actually, if you have a look at the Citigroup Economic Surprise Index, have a look at the relative difference between the US dollar and the Citigroup Economic Surprise of Europe. And that really shows that when effectively that line shows that when you've got that data beating what's expected, you tend to see that index going up. And so what we can see here is with the yellow line is you can see the difference here in the influence that the Citigroup Economic Surprise Index is having against the dollar index there as well. So we are seeing a relative outperformance from US data relative to European data. And we've seen that in the bottom chart there. You can see that the euro as well is really coming into the bottom end of that channel. We're coming down into a multi-month support zone. And again, what will happen as we go through the new week? I think this is something that a lot of people are trading. A lot of people have got on their radar. Is this the time to fade dollars? Is this the time to buy euro dollar based on the fact that we're at those support level, or will price break through there? And that obviously that could have some big implications for financial markets. We're at other big levels as well. You look at cable, you can see that down into 129.50. We're trading at the floor at the moment. You get a break there. You look down at the 23rd of December lows down in 129.05. I think that's an interesting one as well. Of course, we talked about what's happening in WTI gold as well. We've seen a large interest in people looking to trade that 1590, 1550 range. You're not seeing much movement in real yields at the moment for me to get too much of a grip. Stay firmly neutral on the gold price on that. Also, what's happening in Aussie dollar? Have a look at this chart on the lower pane. That 67 cent level, absolutely rock bottom support. The central bank in Australia here have turned neutral. Like the statement from the RBA clearly has an easing bias. Until that's removed, I think people are going to be selling upside. You're not really getting too carried away. But what we've seen from Lowe and DeBell has been one of a much more neutral stance. They really do not want to cut the cash rate any lower than what they're on. The barriers to quantitative easing are very, very high from what we've been hearing from them as well. And dollar CAD, as we come through the new week, is going into that sort of 133.50. That's a big level for me as well. Could we see how will price act in there? As a strategist, I can give you levels. What we do as traders, though, is we see how price reacts into those levels, and that's how we trade that. So if we do get a firm closing break of that supply zone, again, like we saw the dollar index, like we saw with euro dollar, that has big implications for a potential trend continuation, or do we look to fade that? Let's see how price reacts. Now let's have a look at event risk as we go through the new week. I'm going to go to the US. You can see this event risk chart. It's all about CPI here, with the consensus expecting to tick up from 2.3 to 2.5%. Again, will that be good for the US dollar? We've got retail sales coming out on the 15th. The market's expecting that 0.3. That's unchanged. We've got a load of Fed speakers. Again, we expect them to be fairly neutral given what we saw from the financial conditions indices. Probably the one that I'd be picking out there would be Jerome Powell speaking before the Senate Banking Committee. Will he say anything new? Kashkari speaks. He's obviously the big dove on the board there. So we're not expecting anything too significant from them. China comes out with CPI and PPI numbers. They come out with new yuan loan numbers. Obviously, everyone's still focused on what's happening around the news flow around the coronavirus. Hopefully that improves. In Australia, we don't have too much in event risk this week for me really to concern myself with. Home loans, NAB business confidence. I don't expect them to have too much influence on market pricing. In Canada, we've got housing starts and building permits on the 11th. We've got the RBNZ meeting on the 12th. Now, we'll talk about implied vol in a minute there, but no one's expecting any rate change from the RBNZ. In the UK, on the 11th, we've got GDP. Again, I don't expect that necessarily to be a game changer for the pound. The industrial production numbers as well on the same day. In Europe, you've got CPI numbers in Germany and GDP. So we actually, if you look at that, it's a fairly low risk week. There's not anything there that says to me it's going to be a huge game changer. I think that US data will probably be the lion's share. And of course, we've still got these macro themes with what's happening in OPEC, whether that impacts the WTI price and the petro currencies, and of course, will this risk taking continue to suppress volatility and mean we're going to be in these high beta carry trade positions? Now let's have a look at what's happening in the volatility and the interest rate space. As we go through the week, let's have a look at how interest rate markets are expecting for the upcoming one. Immediately on that third right column, you can see the RBNZ pricing. The market's expecting a 3% chance that we see a rate cut. No economists are calling for that cut. It shouldn't necessarily be a vol event in terms of that. But what will the outlook say? So that's something that we're looking at. If you actually look at the outlook for rates, they're pricing in 12 basis points across the swaps curve. So the market's not so sure that we get too much action from the RBNZ going forward. We're at a much more neutral capacity. That in itself is suppressing volatility in the Kiwi dollar. The RBA, well, we go into the next central bank meeting. It's not the 4th of February. I can tell you that. It's going to be in March, the first Tuesday of March. That's an error on my part. But what I can say is what is true is that the market is pricing a 7% chance of a cut at the next meeting. We've got one rate cut being priced around the rates curve. In the US, you can see that the next central bank meeting comes up on the 18th of March. There's an 8% chance of a cut there. It's not going to happen, clearly, in the eyes of the market. We're pricing in 33 basis points of cuts. Now, that was at one stage 2 rate cuts. That was close towards 50 basis points. But this improvement in risk semantics that we've been seeing has seen people looking to fade that move in the rate structure. We're now pricing in about 1.5 rate cuts coming through. In Canada, we've got the next central bank meeting on the 4th of March. The market's pricing that at 12%, so that's the highest probability of any of these big central banks. That's still very low, and we've got 31 basis points in there. So we've come back to a much more neutral setting for central banks when they've pushed out their expectations for when these actions are going to happen. In terms of vol, I've got the realised vol on the left-hand side. I'm not looking at that too closely. For people out there who do use the ATR or Bollinger Bands, you get a sense of how you can use that. For me, it's more about the implied at the money implied vol. But you've seen this come right back a little bit. Have a look at Aussie yen. We're at the 40th percentile. That implied volatility sitting at 8.71%. 40th percentile. Last week it was a little bit higher. The expected move then up or down from the current spot price in Aussie yen, 76 points. It gives you a range 74.81, 73.29 with a 68% level of confidence. I like to use that 76 point for me as someone who trades off 4 hour or daily charts to give me a sense of how much risk I can take, where my stop loss should be, the distance to my stop, and therefore that adjusts my position size. Most people will use the ATR, but you can see that the ATR and implied vol are fairly similar. The 5-day ATR sitting at 72 points, the implied vol 76. Going to Aussie dollar, you've got that sitting 35%, 35th percentile, 6.55, 50 points on the week. Dollar yen, which has been sort of looking to test that sort of 110 level. That's been something that we've been focused on. 4.82%, 63 points up or down. So if you're looking to be long or short and you're trading off a slightly longer term time frame than 5 or 10 minutes, bear in mind that the market is expecting over the next week a 63 point move up or down. It gives you a range of 110.62, 109.36. We've got some of the other index vols that you can see there, the VIX, 29th percentile. You've got the JP Morgan Global FX, which aggregates all of these factors in, sitting at the 7th percentile. I've used the 12-month range there, so it just gives you context. What percentile rank does is it gives you context of where this implied vol has been relative to the 12-month range, so we can get some perspective if it's high or low. Oil vols are still 22 percentile, despite all the craziness we've been seeing. Implied volatility is still pretty low, coming into that capacity as well. So what we've seen is a good situation for me is in terms of what's going on. Event risk for me, it's about the US. Are we going to see that rates pricing coming out? It's probably going to benefit the dollar. If we see that relative performance from economic data, that dollar index is going to continue pushing higher. Why do I say that? Because what we've been seeing is this economic surprise index is clearly benefiting there. I think the way that the dollar's trading relative to, say, the euro against the Aussie is as we're seeing improved data, it's seeing the cyclicality of the currencies working quite nicely. So a lot to look out for. We are expecting less volatility. The event risk is somewhat less skewed this week. I probably will keep an eye on what's happening in the political situation with New Hampshire on Monday, but given what we've seen from Iowa, I think it was a bit of a kerfuffle. It does seem very, very interesting at the moment. The market's not looking at it too closely, but we really do have Bernie Sanders accelerating his lead. A contested convention can't be ruled out. That's becoming increasingly more likely. But keep Pete Buttigieg on your radar as well. I think he's someone that we need to look out for as well, because Joe Biden has sort of phased out. If you wanted to support Biden, you're probably looking more closely at what's happening in Mayor Pete now. So something that we are keeping our eye firmly on, but it's not a market force at the moment. Anyway, if you've got any questions, do reach out to the team here at Pepperstone. If you find yourself liking this video, do click on the like video or subscribe, and that would we'll give you regular updates on when these videos are coming out. Thank you.